Okay, welcome to our podcast this month, March 2026. We are doing a focused podcast this time. It's Do you want to get into the real estate investment game? So, are you thinking about investing your money in all sorts of different things, whether it's mutual funds, CDs, stocks? We're going to talk about how you can get it into real estate and using finance to leverage yourself to get into real estate. So there's lots of different things we're going to talk about. We're going to talk about different ways to get in, different types of properties that can be purchased, what goals you should have when you're considering buying real estate investment property. What's the qualification to get a loan for investment real estate property? And then we're also going to touch on down payments, how much down payment you need to get in. And we're also going to touch on commercial loans too, and commercial property. So we're going to cover a lot in a very short amount of time. So hang in there, and here we go. So there are different types of ways to get into investment real estate property. The first thing you need to do is you just need to target a property. You just need to target something that you want to consider to hold as an investment property and rent it out, basically. And there's a lot of different things that go into that analysis. What is an investment property? An investment property is just that, one that you're not going to live in, that you're going to rent it out for someone else to live in. What kinds of properties can be purchased for investment purposes? All sorts. You can have single family residence, manufactured homes, multi-unit properties. 2 to 4 units are still considered residential financing. 5+ units are considered commercial financing. And if you talk about commercial, gee, the sky's the limit. I mean, you have apartment buildings, shopping centers, gas stations, office condos, office buildings, so many different types of properties that you can look at as far as choosing a real estate investment product. What should your goals be when you buy an investment property? Well, it's going to be return on investment. And so here's a quick little chart, or not even a chart, just a little summary I came up with on that issue. So what we're going to do is we're going to take, let me find my little analysis here. We're going to take, share the screen. Here it is. Can everybody see the screen?
Yes.
Okay, great. Okay, so this is investment real estate versus mutual funds. And I just do this as a very basic overview. Let's say you have $100,000 you're considering investing, and you're thinking maybe I'll put it in mutual funds. Well, at a 5% return, if you're getting 5% of your money, you'll make $5,000 in investment income at the end of the year. Pretty good return, no problem. And the risk is very small. There isn't a lot of risk on just putting it in a mutual fund, other than the market risk, right? Mutual stock markets go up and down, what have you. That's one. Now let's consider that same 100,000 if you did it in real estate investment. So 100,000 is about, if you consider a $500,000 purchase price for a home, is about 20% down. So it's the 100,000 is what you're investing. So let's take a look at that. If you take, assuming a 7% mortgage on a 30-year fixed, and in this analysis, $2,000 a year in insurance and $3,500 in property taxes, the PITI payment, which is principal, interest, taxes, and insurance, that's your total payment, is just about $3,120 a year. I'm sorry, $3,120 a month. And if you have rental income of about $3,200 a month, assuming then you'll have about $80 a month of income per month. And if you're in the same assumption of 5% appreciation. So in the first year, so what is your return? In the first year, if you have 5% appreciation on a $500,000 property, that's $25,000. So that same $100,000 that you would have put in a mutual fund and made 5% on and received $5,000 investment income, in this analysis, same 5%, you've been able to leverage it to a higher valued property, and that same 5% is worth more. It's worth $25,000. Plus, you're going to get the rental income difference in our example of $80 per month, so $960 per year. And in that first year, the tenant is paying about $4,000 towards the principal on your mortgage. So there's a lot of benefits here. Now, there's some other things, though, that aren't in this example. And whenever you see assumptions and you see people say, oh, yeah, you just assume this, assume that, they're just assumptions. Um, when you have investment real estate, things can go wrong. You could have leaks in the roof, so there's going to be capital improvements. You have to pay for roof repairs. You could have air conditioner could go out. You'd have to pay for a new air conditioner. There's maintenance that needs to be done. But if your goal is to hold on to the property for a while, and hopefully the market is such that values will continue to increase, your $100,000 could end up making you a little bit more profit than if you just put it in mutual funds or into a stock or something like that. Just depends, but it's definitely an alternative investment. I provide this for you just to give you a feel for what are the different things that go into a real estate investment. Any of the panel want to comment on that? Any of the panel have real estate investments that they'd like to talk about? I know we do, and all those things I mentioned to you, new roof, new air conditioner, yes. but that's just part of it. But our plan is to hold on to it for a long time. And like I said in the beginning, what is your goal? Is your goal cash flow? Is your goal capital appreciation? You need to know what your objective is when you get into an investment, whether it's stocks, whether it is real estate, whatever it is. What's your goal? Have it be defined. And then when you meet that goal, you can move on. There's lots of different things you can do with investment real estate, like you can sell it and then buy other property and defer tax and what have you, which is beyond what we're going to talk about here today. But there's lots of different things you can do with investment real estate. So picking up where we left off, so that's just kind of a feel for it. So why would you get into real estate? What are the things that you would consider, and what are the types of returns? How do you get a property? Well, a lot of people nowadays just go online. They'll look at Zillow, they'll look at Realtor.com, they'll look at wherever, and they'll just truly, what you really should do is establish a relationship with a real estate agent that you really know and trust, because they do this stuff every single day. They know the market. They know the market that you're looking for, and they will be able to help you find the properties that you want to find. You're going to have to do some negotiating. They're going to be able to let you know what the prices look like in that market, because they're going to do a comparative market analysis. They're going to help you determine what purchase price you can get in, because most investors know the profit is made on the buy. Most investors will tell you the profit is made on the buy. So you're looking to get a good purchase price for your property. So I would highly recommend to go ahead and speak with your real estate agent. So how do in this instance, I don't have full cash to pay for a property. That'd be great. And that's a different analysis. The analysis that we just talked about, you'd be saying, I'm putting $500,000 in instead of $100,000, and you'd be looking for the return on $500,000. That's a different analysis than if you're just putting in $100,000. So you may not want to put the full $500,000. Instead, you may want to use someone else's money to help you acquire that real estate and help you leverage. But how would you qualify for a loan? What are the things you need to consider? And this is an acronym I came up with years ago, actually trademarked it. It's called the acid test of lending. Every single residential loan has these 4 elements in order to get qualified. Number 1 is A, assets. Number 2, C, credit. Number 3, I, income. Number 4, D, down payment. Assets, credit, income, down payment. We're going to break down each one of those. You need to be strong in each one of those if you do a full documentation loan, but we're going to talk about other types of loans too. But in order to get qualified, you need to meet all the criteria of the acid test. The first is assets. This is something that often gets overlooked when people are trying to apply for an investment property. How much reserves do you need? What's a reserve? A reserve is how much money you have saved in a checking account, savings account, CD, retirement account, mutual fund. Lenders want to know how much money you have saved. And as a general rule, they want to see 6 months reserves, meaning 6 months of mortgage payments that you have saved. Fannie and Freddie even get a little bit more specific. They want to know that if you have depending on how many properties you own, if you own 1 to 4 properties, they want to make sure that you have 2% of the aggregate unpaid principal balance of those properties saved. If it's 5 to 6 properties, 4%, and if it's 7 to 10 properties, 6%. The bottom line is you have to have money saved over and above the down payment, because lenders want to make sure that even if you don't have a tenant in there paying your mortgage, you can still cover that mortgage payment for a little while. And that's important. So you have to think more than just down payment. Credit. What type of credit score do you need? FHA, as a minimum, you get 580 credit score. And we're going to talk about how you can use FHA to get into an investment property. FHA loans are only for primary residences. However, we're going to show you how you can use an FHA loan to get into an investment property. Fannie Mae and Freddie Mac typically require 620 to get into primary residence. If you're doing 2 to 4 unit properties, maybe a 660 or 680 credit score. And the VA doesn't have, you can do a VA loan for these. It doesn't have a minimum credit score requirement, but many lenders could require a minimum of a 580 or 620 credit score. For income, if you're doing an FHA or VA loan, the third criteria, income, you're going to need full documentation, such as pay stubs, tax returns, Social Security income, disability income. For Fannie and Freddie, same thing. You're going to need full documentation. They may also look at other ways to qualify. So let's say maybe you don't have a pay stub, but you have a lot of money saved. They can do an asset depletion calculation where you take your assets and divide it by a certain amount. They can also do, if you're of retirement age, monthly distributions from your retirement account as income. And on all these investment properties on the residential side, another piece that the lenders look at is the market rent schedule from the appraisal that's done. What the lenders will do is they'll take 75% of those rents and compare it to the mortgage payment of the property that you're going to be purchasing. And they'll be able to use that to offset that payment. So that's another piece of income that you're going to be getting when it comes time to purchasing an investment property. That's part of the appraisal process. But let's say you don't have any of those things. Let's say, and you still want to buy an investment property. Can you do that? The answer is yes, you can. Believe it or not. You could do something that's called a non-QM loan, which is a non-qualified mortgage loan. And that's a loan that allows alternatives to full documentation to verify a borrower's ability to repay. They use non-traditional documents for qualification. They have interest-only features and maybe higher debt-to-income ratios. The types of non-QM loans are bank statement loans for self-employed individuals. They'll take the business bank statements for the last 12 months or 24 months, take a percentage of those deposits, and use that as income. Or they'll do personal bank statements. They may even take 100% of the deposits from personal bank statements. So those are two different ways that you can use bank statements in order to qualify to prove the income piece. Another loan is profit and loss statements. So let's say your tax returns aren't ready or whatever, or you just want to try to get in on they may not be ready. You can still get in on a signed profit and loss statement from your CPA. Lenders are making loans on signed profit and loss statements right now. There's also DSCR loans, which are very popular in the investment space. DSCR stands for debt service coverage ratio. And what they do is they take the market rents from the appraisal, 75% of that, and they compare it to your mortgage payment. That's the qualification. It's the market rents compared to the mortgage payment. If it's over 1.0, it's a certain rate. If it's under 1.0, it'll be probably a little bit of a higher rate. But you wouldn't have to have income. You don't even have to have employment. As long as you have the down payment and some reserves, like we talked about, you could get a loan. There's a product out there in which, let's say that your market rents aren't all that good. There's a product out there, well, they'll take the 75% of the short-term rental market rents. So therefore, in that instance, you will be able to probably qualify because short-term market rents are even higher than long-term market rents. There are some lenders that will do that. and income and employment is not verified. So DSCR loans are very popular. And then, of course, there's private money, where income and employment are not verified. Typically, the lender visits the property, and it's based on the value of the property. And we'll get into a little bit more of those types, what's involved in those types of loans. The non-QM loans can contain prepayment penalties. So note that a prepayment penalty is like something they'll say, oh, it's a 1 year prepay. So a 1 year prepayment penalty means you may, for the first year, if you try to sell the house or refinance it, you're going to have to pay a penalty of maybe up to 6 months of interest. So that's something to keep in mind. Some of these non-QM products will have prepayment penalties. Down payment, which is the last piece of the asset test. Full doc loans that we talked about before, pay stubs, tax returns, Social Security income, or draws from retirement. For VA, you can buy an investment property for 0% down. 0% down. As long as it's a 2 to 4 unit property and you reside in one of the 4 units. So for veterans, you can do a no down payment loan. You buy a fourplex, and it could be an investment property, and you can get in. FHA, as I mentioned in social media, you can get in for as little as 3.5% down. So you could buy an investment property, a fourplex, as long as you move into it as your primary residence, and you can rent out the other 3 units, you can get in for 3.5% down. Now, FHA has another test. If it's a 3 to 4 unit property, not only does it need to meet debt to income ratio, there's a self-sufficiency test in which 75% of the market rents need to be greater than or equal to your mortgage payment. So that's an additional test. But that's another loan where you can buy an investment property for a little bit of money. For Fannie Mae, same thing, 5% down you can get in if you move into a 2 to 4 unit property. You reside in one, and the other 3 you rent out. You can get in for as little as 5% down, and that's regular conforming loans. Otherwise, if you're not going to be living in the property, for regular conforming loans, the minimum down payment's 15%, but there's going to be mortgage insurance on that. So you're probably going to want to look at 20% down, and the best rates are at 25% down. So that's where you're going to get the best bang for your buck, is at 25% down if you have that. Now, let's talk about those loans that I mentioned before, the VA loan, the FHA loan, 3.5% down, Fannie Mae 5% down. What some people do, and we've had clients like this, they'll live in the property for a year. The mortgage or deed of trust, depending on where you are in the country, says that you need to occupy it as your primary residence for 1 year. After a year, you could choose to purchase another primary residence if you want to, and then rent out that 4th unit in that fourplex. Now you have the whole thing. You just got in for 3.5% down. You have all 4 units rented, and now you went out and purchased another property. Now, be mindful that if your intention one day is to sell that, there are tax rules, which we're not going to talk about, that would make you want to stay in the property for more than 1 year to make it your primary residence. But that's just something we can consider down the road. Those non-QM loans we talked about before, bank statement loans, so if you don't have income that you can prove, 20 to 25% down payment to pick up an investment property. Those profit and loss statement loans, about 25% down payment. Those DSCR loans we talked about, debt service coverage ratio, 20% down payment. And private money, 25 to 30% down. Luckily for us, we have a private money expert on the panel right now. He joined in. Alan does private money exclusively. Anything you'd like to add to that? Mostly the qualification on private money is really based on the property itself, isn't it, Alan?
Correct. And it's subjective. Every investor can be subjective with a property, what that value is. Yes, Zillow may say something, but it's going to be comping. But then condition can affect a valuation. Also with manufactured housing, that can be up and down a scale depending on conditions, single wide, triple wide, double wide, year built. problem with, and I've forgotten the rule, excuse me, for when does FHA on manufactured homes, what's the oldest a manufactured home can be?
Sorry?
1970, I
oldest-
think it's 78.
Okay.
Or
Yeah.
Fannie
Yeah.
Mae?
Yeah. A manufactured home, I think it has to be built after 78. It's got to
78, right.
yeah.
So even on hard money, a manufactured home, we'll do older than 78, but now the exit strategy for that borrower is going to be limited on who they are going to get it refinanced with. They'll have to get it refinanced either with us again or with another private person if it's older than a 78. With it comes to the prepay that you were talking about now, in our case, our investors that I work with is it's 90 days interest guarantee. So if they do pay off after 90 days, there's no prepay. If they pay off at 2 months, they just owe us a month of interest. Or if they pay us off in 2 months and 28 days, you figure out what the daily interest is, and it might be just 2 days of interest as the penalty for that. Now, there is other lenders who will charge, hey, I want you pay off early, I want 6 months of interest, and there are lenders out there that do that. Or a year, like you said, with the non-QM loans, that they're prepay. So that's a little different.
And you'll lend to an LLC, and same thing with the non-QM loans. They'll lend to LLCs.
Yeah, correct.
Where regular full doc, they won't. They'll just lend to individuals.
Individuals, yeah. And we actually, in our industry, we kind of prefer LLCs. So
interesting. That's interesting. No, that's good. There was another point I was going to make, but we'll probably get back to that as we continue moving along here, because the next thing I wanted to touch on was commercial loans, because once you know it, we have an expert on commercial loans on this panel too. What were the chances? But let me so what are commercial properties? I kind of mentioned it before: 5+ units, office condos, apartment buildings, gas stations, shopping plazas. Those were all can be considered commercial properties. The loans are different than what you're going to see in the residential arena. The loans they're typically not 30-year fixed mortgages, because there's no backing by the federal government per se. There are some Fannie loans and what have you, but that's not what we're talking about here today. The loans are typically fixed for 5 to 10 years and are amortized over 20 or 25 years. And they may contain prepayment penalties. So in that instance, it's fixed for 5 years, and then in 5 years, you'll have another rate. So that's something to keep in mind. It's a little bit different. Many lenders want to know what your experience is. So if you have no experience, it may be hard to get a commercial loan. So you may want to start off with a residential rental property first. Get into the residential space, build up some years of being a landlord before you start getting into the commercial space. If you occupy the property as a primary residence, you may be able to get an SBA loan, and Mike is going to speak on those here briefly in just a minute. Conventional loans in the commercial space could require more down payment, 20 to 25%. The commercial loan, though, it's a little bit of a different process. It typically goes in front of a credit committee from that bank or that credit union or whoever that investor is. And then they kind of review the scenario and decide whether they want to make the loan or not and what the terms will be. And the documentation is a little bit more. You're going to have to do a personal financial statement, usually 3 years of tax returns, a schedule of debt, and real estate owned. But let me turn it over to Mike. I kind of just gave some highlights. Mike may be able to break it down a little bit more. Mike, why don't you just share a little bit about your background so people know how much of an expert you have? And is that a P on your shirt there? I can't tell. Is that a P?
Yeah.
And that's because we were filming this during March Madness, and his team is Purdue. His alma mater is Purdue. So
yeah. So yeah, thanks, John. Giving some thought to this, the commercial real estate is a different beast than residential. And as you know, I don't do residential loans. I just don't. They're too different. Some of the bullets to cover, there's a number of ways to get into commercial real estate. Is going to besides going through people like us. You mentioned mutual funds somewhere along the line. You're talking about that. There are types of stock investments or stock-like investments. They're called REITs, REITs. It's real estate investment trusts. And those are, they're trusts, but they kind of look like buying stock in a company. But if you think of it more as a mutual fund of commercial property, you're getting closer to what it is. But you can buy and sell those on the stock exchange for whatever the market price is. And basically what you're doing is turning over your money to a real estate manager, investment manager, who's going to go out and buy and sell, collect rents, and do all that sort of thing with commercial real estate. For the investor, it's hands off. They buy the shares and go fishing or whatever they do, and sit back and get rent checks. So you don't have any control as an investor in what properties you buy, how you manage them, what the sinking funds are, what the reserve requirements are, what kind of financing they're getting on them. That's all done left with the manager. So that's one avenue to get into commercial real estate without dealing with people like you and I, John. And a lot of people like those, retirement people particularly, like REITs. There's some downfalls to them. Full disclosure, you ask, what do I do? How much of an expert am I? Once upon a time, I was a stockbroker for 10, 11 years. So I know of what I speak. I'm not a broker now. Again, full disclosure, I don't do that anymore. Another thing that I did once upon a time, John, I owned a commercial real estate company there in Phoenix. Had that for 25 years. Specializing in gas stations and niche segment. So as commercial real estate goes, I kind of have my foot in the real estate segment. Again, full disclosure, I don't do that anymore. So what I'm doing now is financing commercial real estate. But I know a little bit about these other things. If you're going to invest in commercial real estate, it's best that you identify what your sweet spot is. What segment of commercial properties are you going to look at? Because your lenders all specialize in a segment. You'll find lenders that have, they want to do retail, or they want to do office, or they want to do medical office. Today, a lot of people are looking for data centers, which are kind of a type of industrial property. So you get little niches here within primary segments. And as an investor, you want to look at those segments and figure out, as an investor, what segment do you want to invest in? Some are going to be more permissive in terms of dollars. It's going to be really hard to get a data center investment for $500,000. So the amount of capital the investor has available is going to dictate a little bit what they can get into. But however that's driven, you want to identify a segment to go after, and maybe even a sub-segment. I mentioned gas stations. Maybe you want to invest in fast food restaurants. You want to back your brother-in-law who just got a McDonald's franchise, perhaps, something like that. You need to realize that restaurants are a sub-segment of retail. Maybe you want to invest in movie theaters. Don't know why, but maybe you do. So, but you want to identify that going in, because the lenders that you're going to be talking to are going to link with those specialties. Okay, so everybody in the commercial real estate business tends to specialize. And that would apply also to your real estate broker. If you have a real estate broker that specializes in everything, that's the same as saying they specialize in nothing. Okay, so just a little bit on where to go and look for this kind of thing. You also want to recalibrate your idea of what's a lot and what's a little. And that would relate mostly to time and money. Commercial real estate is thought to have a higher price tag for investment for entry level than residential, and that's true. Okay? Also, time is something. A lot of people think, I don't know, long-term capital gain is what now, 12 months, 18 months? How long?
I think it's 12 months. I think it's
12,
1 year.
okay. So talk to real estate investors, those that flip houses. When I go in, they want to do the fix-up on it, put it back in the market, and sell it in 12 months and 1 day to get that long-term capital gain consideration. That's a really short time frame to try to build an investment model for commercial property. A lot of those have windows or have time frames for holding of maybe 5 to 7 years. That's kind of a common hold. And if you talk to your finance people, you'll see that, oh, gee, coincidentally, those loans want to be 5 to 10 years. So lenders kind of see, they kind of dictate what that is too. So anyway, oh, you talked about credit. Can you get credit? FICO scores, most commercial lenders would like to see FICOs of 680 or higher. That's kind of a threshold. If you get down below that, you're probably going to start looking for hard money loans that are going to be a little more punitive in terms of terms, conditions, rates, that sort of thing. So if you haven't run a credit check on yourself, you want to do that. One of the things to look at is risk. There's all kinds of risk. You know, one risk we had in about 2009, 10, 11, where market values went below debt levels and people ended up underwater, negative equity. So the market can give you market losses in real estate. And I say that because a lot of people, especially if you haven't looked at commercial property, maybe you're kind of new to the business or so, there's this idea that all I got to do is buy it and it'll go up. And we know it doesn't work that way, okay? So market values is a risk that should be looked at. The other is, a big one is liquidity risk. You buy that and things happen, and maybe you don't bake in all the contingencies into your business plan or your investment plan for all the accidents that can happen out there to you financially. And so you have a really nice 5 to 7 to 10 year holding plan coming up, and you got a personal event in your life that causes you to want to sell that property after, I don't know, 2 years. Well, maybe the market is such that you can't really sell it very well in 2 years. And if you do, you're going to be asked to carry the financing yourself. You're going to be asked to take a bath or a haircut on the price. And so there's going to be penalties for liquidity. If I contrast that perhaps with my REITs that I mentioned in the stock market, those are tradable like a stock. Buy it and sell it. It settles in one day. Okay. So liquidity risk is something people don't consider a lot with regard to commercial real estate, because your sales cycle there is going to be long term. I think when I was doing commercial real estate, even once you got an offer and got it into escrow, commonly would go 4 to 6 months to close, and that was without any problems. Just takes time. You want a fast close, you're going to take a beating on price, because your buyer is going to have to go out and get a bridge loan to close it fast for you, and they're going to let you pay the difference on that loan. There's also what I call legislative risk. That's risk sometimes that materializes in the tax code. That's our government taking care of us. So you may get changes to the tax code, or agencies come up with new criteria that affects your property. In the gas station business, we were always sensitive to what ADEQ and the EPA had to say about gas stations. And sometimes if you're going to be the owner of that gas station, maybe you rent it out to a gas station operator, and there's a requirement there to do something related to environmental compliance, whatever that might be. And maybe your lease didn't cover that. And so that's what they call blind to, quiet on the point. And that is, the lease doesn't say who pays for that. So now you've got a midterm negotiation with your tenant for compliance with a legislated requirement. And you need to be sensitive to that. Liquidity risk we talked about. I've got some notes here I made. Oh, sovereignty risk. If you're gonna buy land in Greenland, you want to know about this.
Well, we do have people that come to us and they'll say, "Hey, I want to buy something in Mexico."
Mexico and Canada, those are the two. So sovereignty risk extends that legislative risk into another country, basically what it is. And if you're going to own land in another country, you want to do a little quick check or maybe hire somebody to do a little quick check, due diligence on what the political climate is there. And I can tell you probably right now that some countries are not really happy with America. I think in terms of Canada, you know, we're not their favorite country, even though we're neighbors next door. So these are just different risks that maybe when you're buying a house to invest, you don't really cover those bases too much because they're kind of immunized from them. Another thing, John, you mentioned here the SBA. A lot of people that want to invest in real estate own small businesses, sometimes not so small. But if you own the business, you occupy a property. And a lot of those businesses, if they were startups or maybe moving around trying to get a better property, they have a lease with them. A lot of the best investments that business owner can make is to buy his property that he's renting. And you can get SBA loans to do exactly that. And those, if you've occupied the property for any length of time, a couple of years or more, you've seasoned the business, you've got historical financials that show that you've paid the rent. Now you can pay their mortgage. Those are good investments for business owners to make. And it doesn't necessarily go to your income statement on a month-to-month basis, but it will go to your bottom line on your balance sheet, which is your wealth creation device they talk about. So if you're going to own a business and you're going to go into business, as opposed to jumping on that lease right out of the blocks, you might want to look and see if you can get a loan and maybe even buy the property that you would otherwise occupy as the business. Okay. So whether you're currently in it now or you're going to go into it, it's just another alternative to look at. Pico's talked about that. Oh, terms and conditions in contracts. All the contracts that you've seen that are put out by for residential properties will not serve you very well looking at a commercial property contract. There's not necessarily a template. Every lender might want to have something they like, but a lot of times if you're using a broker, which I suggest you do in buying the property, that broker generally is going to provide you with the contract. In Arizona, the Department of Real Estate has standardized, back when I left real estate, what, John, in 22, I think it was, 2022?
Yep.
So when I left, Department of Real Estate had standardized terms and conditions on a commercial contract. I never came across one. I think the people that use commercial contracts like that are people that don't do a whole lot of commercial property. But if you've got a dedicated commercial real estate broker, that broker is going to have their own contracts. Okay. And you want to get a look at those before you start to sign them and fill them out. Even just get it for what they call form and content. Get it to take a look at it and talk with somebody about the glossary of terms you'll need, or maybe just Google them and you can find out what those are. But those contracts are going to be different than what you've seen in buying a house, whether it be for investment or for occupancy. You know, in today's environment, we've got high inflation. We've got relatively high risks at the medium and long end and relatively short risks on the short end. So we've got kind of a squirrely yield curve, which means lenders who pay a lot of attention to this because they're trying to go out there and make a spread and keep a spread on 5 to 10 year term. And that's very difficult to do in today's environment. So a lot of them will want to offer variable rate loans. They'll offer you variable rates. One of the things that they'll typically put in there, and if they don't, you can ask for it, is what they call a rate cap. And that's kind of max, just like it sounds. They put a cap on how high a rate you'll have to pay. So it's your insurance policy against upside interest rate movements, yours as the investor. Like any insurance policy, you're going to have a premium to pay on it. So if you get a cap, you're going to find a chunk of money going into that cap at closing, and it'll be called something. But what you're going to do is you're going to put a lid on how high interest rates might go for you in your case, and where you're probably going to be looking at least a 5-year fixed, maybe 5 years fixed and adjustable for the next 5, something like that. rate caps are something you should expect to see in there. There's another type of hedging device that's used a lot. It's called swaps. You may have come across them or not. It's just another way of having the lender mitigate his risk and interest rate movements. And I don't want to say much more about that because that gets real sticky after a while. Okay. One of the things you'll be asked to do for your lender is to offer them not really a business plan, an investment plan that will come up with what is your exit strategy. Easy to get into these things. How do you get out of them? Okay. So you'll need to put together a strategy on what you're going to do and how you're going to do it. And you'll need to put in there the contingencies that you're allowing for. You'll write into there for those contingencies specified amounts of liquidity, contingency funds, sinking funds, they sometimes call them. You'll be asked to take your rent payments and break those down into where does that money go. You can't take all the rent payments and go to Disneyland. You have to. Part of it goes to pay the rent, to pay your mortgage, and then part of it goes generally into a sinking fund of some sort, which is just kind of a savings account for contingencies for further and different things. But you'll need to put that into your investment plan. That will need to be written out. Either your real estate broker or your mortgage broker can either ghostwrite those for you with in consultation with you, or kind of hold your hand and let you write it up. If you go to a mortgage lender, and that lender is a loan officer or a management executive or something like that at the bank, if that person's an employee at the bank, they're restricted from helping you with that for conflict of interest. So that's something to be aware of when you look at people like us and say, well, you know, why do I need you? I'll just go get a loan. The lender that you go to when you walk in the door, if that person is sitting at a desk and they have a title there and it says whatever the name of the company, Wells Fargo or equivalent on the card, they work for that company. They don't work for you. And they're going to be limited in the advice that they can give you. And that's just to know. So one of the reasons to maybe hire somebody like us, huh, John? Okay.
Yep. What's our slogan there, Mike?
How much money do you make on these things? Commercial real estate, the fancy terms is you can calculate a return on equity or a return on investment. And the equity, you know, is how much money you put into it. The investment is what the total amount is. So the reason you would have return on investment is because your cost to borrow and to operate is less than you're going to be able to get an investment. So you can make, if you go out and get a loan at 5% and you can get a cap rate of 6 or 7%, you can say, well, gee, if I borrow money, I can make 1 or 2% on the amount I borrow. And so if you can get a return on equity, that reflects that investment, the leverage in there. So if you get a return on investment of, 7%, and you leverage that out at 70% leverage, 70% loan, and you can make an extra, 3% on that, then your return on equity goes from 7 or 8, maybe up to 12 or 13. That's all pre-tax. So we're not going to talk about the taxes here. I think it's too messy. Who's on your team? You really want to have a team if you're going to go out and involve yourself with commercial real estate. The obvious person on your team is your commercial real estate agent, your broker. Your next obvious one should be us. Okay, we can wear a lot of hats and talk to a lot of people in terms that might be foreign to you. And we would hear what they say with ears that are maybe different than yours, right? You need to have a tax advisor. That's not just a tax preparer. That's not going down to H&R Block or one of these kind of guys and have them, try to advise you through the year. You want to be able to have somebody talk to you in terms of tax planning. You don't want to start your tax planning January 15th for the year before. So tax planning is something you do along the way, and you need to secure a tax advisor who will also probably do your taxes. but they need to have a broader scope on their services than just prepping taxes for you and filing for your extension. Your lender. You're going to have third parties. You're going to need, among other things, you'll need an appraiser. You're going to need an environmental consultant. You're going to need, maybe structural inspections. We had specialists when I was doing gas stations. We had specialists come out and just inspect the UST systems. They were different than the building inspectors. They went down on the ground. So you're going to need to find a team of people that you can draw on. Some of these people are going to cost you money. You know, the cost to go into commercial real estate, not talking about the investment itself, but just the cost to get there is probably in larger numbers than you might be used to if all you've ever done is buy a house. You know, it's real easy to go out and spend, I don't know, $10, $15, $20,000 just doing third-party reports and people who bill at $300 or $400 an hour, for instance. Okay. So you need to be ready to spend some money, and yeah, it's deductible, but until you're in the 100% tax bracket, it's coming out of your pocket. And that's all I got on my notes, John. You have anything you want to
that's great.
comment on?
No, that's great. That's a great primer on commercial lending. And anybody want to add to that?
Yeah, can you give an idea of the difference between the SBA loan as an owner-occupied investment property versus what a commercial loan would be, interest rate wise and stuff?
Right, yeah. Commercial property today, if you go out, let's see, prime. What's prime? 7.5?
6 3/4.
6 3/4, boys, for sure I am. So today you go out, you could find conventional commercial loans, 6 1/4. You know, prime minus 1, 1.5, something like that, for an income-producing property with an experienced investor. All right, and then it will mark from there. And those, you can either get a fixed loan rate with one of the hedges, either the cap or the swap, or you can get a variable rate loan, which doesn't have that interest rate risk because it's in the loan that you're getting. And those go typically, John mentioned 5 to 10 years. I've seen some go 15, 12. The cardinal 5-year is not magic. We did one time for a guy buying a couple gas stations that had a loan term of 7 years and 4 months or something weird like that. So they get very creative in trying to make the arithmetic work, and that's what drives the terms and conditions, is the arithmetic on the transaction. SBA loans. SBA loans are set by SBA guidelines. They're actually made, well, most of them. There's 3 different types of SBA loans. The most popular you'll probably come across is what they call a 7A loan. It's going to require the book says 90% leverage, 10% down, you can get one of those things, unless you're in a specialized property, and then you might see it go to 15, maybe up to 20% for special use property. They're going to be 25-year fully amortized. They're going to be variable rate, generally prime plus a markup. So prime's at 6 3/4. The maximum the lender can charge is prime plus 2 3/4.
Nice.
The ones I did in the past when I was doing these things, generally came out to be about prime plus 1 3/4 to 2, maybe 2 1/4. So at 6 3/4, you get see an SBA loan today at about 8 3/4 for planning purposes. Again, that FICO ought to look about 680 or better. One of the things about that 25-year fully amortized, and this is something that I think has a lot of value today, and that is that rate is adjustable or variable with regard to prime. So if prime is going to go up or down that 1/4 of a point, the bank is going to raise that rate for the payment 1/4 of a point. In today's, where we're getting a new chairman of the Fed here in a couple months, who's promised to give us lower interest rates, if those rates indeed do come down, that payment is going to come down for as long as it lasts, right? You don't see that in the long end. Conventional loans typically price off the 10-year treasury. And the 10-year treasury is with the bond vigilantes today, and they've been working that long end up. So every time for the last year or so, every time we had the rate decrease at the Fed, the 10-year bumped 10, 15 basis points up. So they've been spreading the short and the long end. And so in today's market, if you can live at the short end, which the SBA loan would do by basing off of prime, and you get it adjustable with rates coming down, that's a more attractive loan if you've got a guy wanting to buy a business that he will occupy. Somebody who wants to buy a, I don't know, small factory. He's a wholesaler. He can occupy an industrial business park type of property, and it might have might be a building that's built out for 4 units, something like that. If he'll go in and occupy 50% plus 1 foot of the property, he's considered an occupant of that property. The other parts of that property he's able to lease out. He just needs to occupy that 50%. Whether he uses it or not isn't the issue. But if he's going to buy 4 properties, 4 spaces in one property, and they're equally divided, 25% in each one, he's only going to be able to go out and rent 2 of them. Whether he uses the third one or not, it doesn't matter. But for lending purposes, he's got to show that he's going to occupy 50% of that property. The other has to do with the prepayment penalty on this. The SBA has on the 7A loan, they have a prepayment penalty that's 5% in the first year, 3% in the second, 1% in the third, and nothing after 3 years. So although you have a 25-year fully am property, you've really got a repayment schedule that looks an awful lot like a bridge loan, short-term bridge loan. You can get bridge loans that go out 3 years or 1 or 2. 1% in that third year is generally digestible. If there's reason and terms that somebody would want to refinance in that third year, the prepayment's only 1%. Okay, so you've got a 25-year loan. So if you take it on now and maybe rates get low through the balance of Trump's term, okay, and at the end of that, they're in their third year, they go out and maybe at that time, inflation has gotten so that the Fed's having trouble keeping interest rates down and they have to start to raise them. After that third year, they can refinance that out and go out and lock it some other kind of fixed loan if they want to. Okay. What else?
No, so it sounds like
is there anything else you wanted on that, Clay? Hello?
Yeah, he's got his mic is off.
Sorry.
Oh,
No, don't want to create background noise.
Was there anything else you wanted on that?
No, that's good. Thanks.
Okay.
Yeah, it seems that if you have the down, you get better terms on the conventional than the SBA.
Well, the SBA, one of the biggest benefits I think that I've seen SBA borrowers use is come in and say, I can buy this with 90% leverage. I only need 10% down. And on a 7A loan, they'll finance not just the real estate, they'll finance the business. So if you're buying, I don't know, a pizza parlor, and there's an ongoing business, and you want the ongoing business because doing a startup has a lot more risk than buying something that's already working, right? So you have furniture and fixtures, you have inventory. Those are generally the only 2 things that are not real estate. So you'll get an appraisal on a commercial property with a business. They will have a value for the business and a value for the real estate. And you put it together and they'll finance the whole thing. If you take that same investment and you take it to a conventional lender, they're going to typically finance 65, 70, maybe up to 75% of the real estate, but none of the business assets. So if the business is, I don't know, 25%, 30% of the value, that's got to be paid for by the investor. And then they'll get the loan for 65, 70% of the real estate only. So you put that all together and you work them out. When I've had to do this, it generally worked out for buying the real estate and the business. They had to come up with about 50% of the total package. So taking a business with real estate and trying to do it conventionally, you lose all your leverage. Much easier to go over and put the 10% down, and that would leave you more reserves, and it just pencils better if there's a business involved.
No, that's great. That's great. We're getting close to the top of the hour, the end of this podcast. One last piece that I wanted to talk about, and it applies to both residential and commercial, but it really doesn't. We've been talking about more longer term holds for investor, is fix and flip, because a lot of people want to buy that property that is in foreclosure, tax sale, whatever, try to get it really low, fix it up and flip it. Those types of properties, typically there are hard money loans, right, Alan, on fix and flips. That's typically what you see, right?
Our biggest bulk of our business is the fix and flip market, and it's really just them. We do a lot of loans also where we cross collateral on other properties. So typically, if an investor is buying, let's say, a pretty depressed house, needs a lot of work, we'll be doing 70% of the value of that property, or the purchase price of that property. So they're needing to come in 30%, but some of these investors don't have that 30%, or prefer not to dive into their retirement funds or other funds to do the 30%. So we're able to take another property that says free and clear, and if we do 70% of the purchase and 70% of a refi of another property of its value, now we're doing 140%. So here we're giving 100% financing, plus giving them money for the closing costs and giving them money for the rehab of the property, so they're not having to use any of their money. And since they're keeping it at such a short term, generally a fix and flip will keep a property, to do the work, and unless they come in with some issues of permitting or something like that can delay a deal for them to finish the property, they're keeping the loan only 90 days, 4 months, maybe 6 months at the longest. Now, some of these investors will be doing a fix and flip property. They get into it, and they realize with the market, of the rental market being so good, the return on money on that is they'll end up just keeping it we generally do a 2-year term. They're keeping it for a couple of years just to make the rental market, it can go that direction as well. Sure. So, but yeah, it depends on each individual investor or fix and flipper. You got two camps, so to speak. You got the investor who is a contractor himself, who does the work himself. Some of these guys will actually live in the property while they're fixing it up, and they'll work on the property to save money on labor costs and things like that. And they fix the property up and then they flip it. Others don't have much of that experience and they farm out all that work, the contractors. And so that tends to cost of, will run up the cost of rehab for an investor due to farming out all those services, as opposed to somebody who can do it in-house and do it themselves. So you'll have two of those types of camps on the fix and flip. So
no, that's good. That's good. Well, guys, this was great. And Mike, what's our slogan? You alluded to it during your talk.
We work for you, not the lender.
That's it.
Yeah.
That's what we do. And that's why he said when you go to a bank, they're only going to be able to offer the bank's terms if you come to us. Oh, my goodness. We have so many sources.
You go to your local bank, you get product A, B, or C.
Yeah, we have Bank A, Bank B, Bank C, life insurance company D, credit union E, go down the list. So anyway, this is great. This is a great primer on real estate finance. We just kind of glossed over a lot of things in a very quick time frame. So if you have questions, please reach out. We'd be happy to answer. And otherwise, have a great day and a great spring. We're in spring now. So
Thanks,
care.
John.
All right, thanks, guys.
It's 36 degrees here and the wind's 20 miles out of the north.
in Indiana. Thanks, guys.
Thanks, John.
All right.
All right,
Take
see
care.
bye-bye.
Bye-bye.
Bye.